What if I told you that skipping one restaurant meal every week could become one of the smartest financial decisions you ever make? Imagine investing just $25 every week, not thousands of dollars, not your entire paycheck, but only $25. It may not sound like much today, but with patience, consistency, and the right investing strategy, that small habit could eventually grow into a portfolio worth hundreds of thousands of dollars while producing monthly passive income. The biggest misconception people have about investing is believing they need a lot of money to get started. The truth is that building wealth is usually less about how much you begin with and more about how consistently you invest. Today, I'll walk you through one of the simplest long-term investing strategies used by many successful dividend investors. We'll cover how dividend reinvestment works, why consistency matters more than timing the market, how to choose quality dividend stocks, and finally, we'll see what could happen if someone invested only $25 every single week for the next 30 years. Let's get started. Section 1. Why small investments matter. 1:15-3. Many people delay investing because they think their contributions are too small. They say things like, "I'll start when I have $5,000. I'll wait until I earn more. I'll invest after I pay everything off." Unfortunately, waiting is often far more expensive than starting small. The real advantage comes from giving your investments time to grow. Every dollar you invest today has decades to compound. Think of planting a tiny tree. During the first few years, it barely grows. But as time passes, it becomes larger, stronger, and eventually provides shade and fruit for decades. Investing works exactly the same way. Your money grows slowly at first. Then the growth begins accelerating because your earnings start generating additional earnings. That's where compounding becomes incredibly powerful. Section 2. Understanding dividend reinvestment. 3-5:30. Many companies reward shareholders by paying dividends. A dividend is simply a portion of a company's profits distributed to investors. Most beginners receive those payments as cash, but there's another option that can dramatically increase long-term returns. Instead of spending the dividend, you use it to purchase additional shares automatically. This process is known as dividend reinvestment, often called DRIP. Here's an example. Suppose you own 100 shares of a company. The company pays $1 per share annually. At the end of the year, you receive $100 in dividends. Instead of withdrawing that money, you purchase more shares. Now you own more shares than before. Next year, those additional shares also generate dividends. Then those dividends buy even more shares. Year after year, the cycle repeats. Your investment begins growing faster because every new share creates additional income. This is the power of compounding in action. Section 3. Dollar cost averaging. Another important reason investors like investing every week is something called dollar cost averaging. Nobody consistently knows when the stock market will reach its highest point or its lowest point. Trying to predict those moments usually leads to mistakes. Instead, smart investors simply invest on a regular schedule, whether prices are high, whether prices are low, whether markets are excited or fearful. They continue investing. When prices fall, their fixed investment buys more shares. When prices rise, it buys fewer shares. Over many years, this helps average out the purchase price while removing emotions from investing. Consistency often beats perfect timing. Section 4. Why automatic investing helps. One of the easiest ways to stay disciplined is automation. Set up automatic weekly investments. Set your dividends to reinvest automatically. Then allow the strategy to continue without constantly checking market prices. Section 5. Choosing dividend stocks. 8:15 to 11. Not every dividend stock is worth buying. When evaluating companies, many long-term investors focus on several important characteristics. First, look for financially strong businesses. These are companies with stable earnings, recognizable brands, and long operating histories. Second, consider businesses that have consistently increased their dividends over many years. A company that regularly raises its dividend demonstrates confidence in its future earnings. Third, pay attention to dividend growth, not just dividend yield. A rapidly growing dividend can significantly increase your future income. Finally, look for companies that still have room to grow their business. Strong revenue growth combined with increasing dividends can create powerful long-term returns. Instead of chasing the highest dividend yield available, focus on quality. Reliable companies often outperform risky high-yield investments over decades. Diversification also matters. Owning companies across different industries helps reduce risk if one sector experiences challenges. Section 6. Sample Dividend Portfolio, 11 o'clock to 12:45. As an example, imagine building a diversified dividend portfolio that includes companies from several different sectors. You might include businesses in healthcare, consumer products, technology, retail, utilities, and dividend-focused ETFs. This provides exposure to different parts of the economy while creating multiple sources of dividend income. Remember, this is simply an educational example, not financial advice. Always research investments carefully before making any decisions. Section 7. The Power of Investing. $25 every week. Now let's look at what consistency could accomplish. Suppose you invest only $25 every week. That's approximately $100 every month, or about $1,300 per year. At first, your portfolio grows mainly because of your own contributions. After several years, dividends begin making a noticeable impact. Eventually, those dividends purchase additional shares. Those new shares generate even more dividends. As decades pass, compound growth begins doing most of the heavy lifting. Depending on market performance, dividend growth, and total returns, a disciplined investor following this strategy for 30 years could potentially accumulate a portfolio worth several $100,000, or even more. A portfolio of that size may eventually generate meaningful passive income through dividends alone. Of course, actual results will vary based on investment performance, market conditions, and individual decisions. There are no guarantees in investing. But history has consistently shown that long-term investing rewards patience. The biggest lesson isn't about finding the perfect stock. It's about building the habit. Small investments made consistently over many years can produce life-changing results. The sooner you begin, the more time compound growth has to work in your favor. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more videos about dividend investing, passive income, and building long-term wealth. Thanks for watching, and I'll see you in the next video.